Are you interested in investing in real estate but don't know where to start? Look no further. Real estate investment trusts, REITs, offer an easy and convenient way to get involved in the real estate market without the hassle of dealing with physical properties. In this video, we'll explore REITs, how they work, and what you need to know before investing in them. Whether you're a complete beginner or an experienced investor, we'll provide you with all the information you need to get started with REIT investing. So let's dive in. What is a REIT? A REIT, or Real Estate Investment Trust, is a type of investment company that owns and operates income-generating real estate properties. REITs were created by Congress in 1960 to provide all investors with the opportunity to invest in large-scale, income-producing real estate. REITs typically invest in various types of real estate, such as apartments, office buildings, shopping centers, industrial properties, and even hotels and resorts. They generate income through rent, leasing fees, and property sales, and distribute a significant portion of their taxable income as dividends to their shareholders. One of the main advantages of investing in a REIT is the ability to gain exposure to the real estate market without having to purchase and manage property directly. REITs also offer the potential for attractive returns, diversification benefits, and liquidity, as they are publicly traded on stock exchanges like other securities. The different types of REITs. There are several different types of REITs, each with its own investment strategy and focus. Here are some of the most common types of REITs. 1. Equity REITs. Equity REITs are the most common type of REITs. These REITs invest in and own income-producing real estate properties, such as office buildings, shopping centers, apartment buildings, and warehouses. Equity REITs generate income from rent, leasing fees, and property sales, and distribute a significant portion of their taxable income as dividends to their shareholders. 2. Mortgage REITs. Mortgage REITs invest in mortgages and other types of real estate loans, such as commercial and residential mortgages, and earn income through interest payments. These REITs may also invest in mortgage-backed securities or other types of debt securities related to real estate. 3. Hybrid REITs. Hybrid REITs combine both equity and mortgage investments in their portfolios. These REITs may invest in a mix of income-producing properties, mortgages, and other real estate-related assets. 4. Public non-listed REITs. Public non-listed REITs are similar to publicly traded REITs, but they are not listed on any public exchange. These REITs are typically sold through broker-dealers or financial advisors, and may have limited liquidity. 5. Private REITs. Private REITs are not publicly traded and are not required to register with the SEC. These REITs are typically offered to accredited investors, and may offer higher potential returns but also involve higher risks. 6. Residential REITs. Residential REITs invest in and own residential properties, such as apartment buildings, single-family homes, and student housing. 7. Commercial REITs. Commercial REITs invest in and own commercial properties, such as office buildings, retail centers, and industrial properties. The advantages of investing in REITs. There are several advantages of investing in REITs, including 1. Diversification. Investing in REITs allows investors to diversify their portfolios beyond traditional stocks and bonds. REITs offer exposure to the real estate market and can help investors diversify across different types of properties and locations. 2. Steady income. REITs generate income from rent, leasing fees, and property sales, and typically distribute a significant portion of their taxable income as dividends to their shareholders. This provides investors with a reliable source of income, which can be especially attractive in times of market volatility or economic uncertainty. 3. Potential for capital appreciation. In addition to generating income, REITs also have the potential for capital appreciation as property values increase over time. This can provide investors with long-term growth potential and may help offset inflation. 4. Liquidity. REITs are publicly traded on stock exchanges, which provides investors with liquidity and the ability to buy and sell shares quickly and easily. 5. Professional management. REITs are managed by experienced real estate professionals who handle the day-to-day operations of the properties, such as maintenance, leasing, and tenant management. This can save investors time and effort compared to owning and managing real estate properties directly. The disadvantages of investing in REITs. While investing in REITs can offer many benefits, there are also some potential disadvantages to consider. Here are some of the drawbacks to investing in REITs. 1. Market risk. Like any investment, REITs are subject to market fluctuations and may experience periods of volatility. Changes in interest rates, economic conditions, and real estate market conditions can all impact the performance of REITs. 2. Lack of control. When investing in a REIT, you are essentially pooling your money with other investors to purchase a portfolio of properties. This means that you have limited control over the management and operation of those properties, and decisions are made by the REIT's management team. 3. Management fees. REITs are typically managed by professional real estate management teams, who charge fees for their services. These fees can reduce the returns on your investment and may be higher than the fees associated with other types of investments. 4. Lack of transparency. REITs are required to disclose certain financial information to investors, but they may not provide the same level of transparency as investing in individual properties directly. This can make it difficult to fully understand the risks and potential rewards associated with a particular investment. 5. Tax implications. While REITs can offer tax advantages, they can also be subject to complex tax rules and regulations. It's important to consult with a tax professional to fully understand the tax implications of investing in REITs. How to choose the right REIT for you. Choosing the right REIT to invest in can be a challenging task, as there are many different types of REITs and factors to consider. Here are some tips to help you choose the right REIT for your investment portfolio. 1. Determine your investment goals. Before investing in a REIT, it's important to identify your investment goals and objectives. Do you want to generate regular income, achieve long-term capital appreciation, or a combination of both? Different REITs may be better suited for different investment objectives. So it's important to align your goals with the investment opportunity. 2. Evaluate the REIT's track record. Look at the REIT's historical performance and track record. Evaluate factors such as its dividend yield, total return, and financial strength. Consider the REIT's long-term growth potential and whether it aligns with your investment objectives. 3. Consider the property type and location. REITs invest in a variety of property types, including office buildings, retail spaces, apartment complexes, and more. Consider the property type and location of the REIT's holdings and whether they align with your investment objectives and risk tolerance. 4. Assess the management team. The management team of a REIT plays a critical role in the success of the investment. Research the management team's experience and track record in the real estate industry, as well as their investment strategy and approach. 5. Evaluate the fees and expenses. Different REITs may have different fees and expenses associated with them, including management fees and brokerage fees. Be sure to evaluate the costs associated with investing in the REIT and whether they align with your investment objectives. 6. Consider the economic and market conditions. Real estate market conditions and economic factors can impact the performance of REITs. Evaluate the current economic and market conditions and consider how they may impact the REIT's performance and your investment objectives. How to invest in REITs. Investing in REITs can be done in several ways, including through the purchase of individual REIT shares or through investment in a REIT mutual fund or exchange-traded fund, ETF. Here are some steps to help you invest in REITs. 1. Determine your investment goals and objectives. Before investing in REITs, identify your investment goals and objectives, such as income generation or long-term capital appreciation. 2. Research and select a REIT. Conduct research to identify a REIT that aligns with your investment goals and objectives. Consider factors such as the property type, location, management team, and financial performance. 3. Open a brokerage account. To invest in individual REIT shares, you will need to open a brokerage account. Choose a brokerage that offers access to the REIT market and meets your investment needs. 4. Place an order. Once you have identified a REIT to invest in, place an order through your brokerage account. You can purchase REIT shares using market orders, limit orders, or other order types. 5. Consider investing in a REIT mutual fund or ETF. If you prefer a more diversified approach, consider investing in a REIT mutual fund or ETF. These investment vehicles provide exposure to a broad range of REITs and may offer lower costs and greater liquidity. 6. Monitor your investment. As with any investment, it's important to monitor the performance of your REIT investment and make adjustments as needed. Investing in REITs can be a way to diversify your investment portfolio and gain exposure to the real estate market. By conducting research, choosing the right investment vehicle, and monitoring your investment, you can make informed decisions and achieve your investment objectives. Thanks for watching, and if you enjoyed this video, be sure to give it a thumbs up and leave a comment below.